The U.S. Treasury is set to auction $125 billion worth of notes and bonds this week. We're watching demand at these auctions as an indication of how the market is thinking about the Fed's moves going forward. Joining us now is Michael Cudzil, PIMCO Senior Bond Portfolio Manager. Michael, it's great to have you here. Let's start with the Treasury auctions that we are going to see this week. We've seen yields move just a bit lower. What are you expecting to see demand-wise for these upcoming auctions, and then ultimately what that signals here for the Fed and the market's path forward?
Yeah, thanks for having me. Appreciate the time this morning. Certainly, significant size of Treasury auctions for this week and for the foreseeable future. Although Treasury auctions won't be increasing, they are at record high levels, and so a lot for the market to digest. But nothing the market can't digest. We've seen the market digest similar levels of supply, and they'll continue to do so, whether it's at slight concessions to where we are now. But these levels of rates, just peeling back the lens, are quite attractive to investors, and we can dive into that a little bit deeper. But the rates on offer today, 5.10 on the U.S. Ag, real yields of 2.25%. These are levels that, aside from 4 months in the past 15 years, you haven't seen, and so these are yields that are attracting investors. And whether or not there needs to be a slight concession this week to absorb these auctions, bigger picture, these are yields that are attracting investors. And given what the Federal Reserve told us last week, it seems like these are levels that you want to start adding duration to portfolios.
What does that duration look like then?
So again, given the Fed's reaction function, which all else being equal, either they'll stay on hold for a little while longer, maybe eventually cut rates, but a hike is an extremely low probability, something they push back on several times. And so from that standpoint, we kind of like the belly of the yield curve, the 5 to 7 year point of the yield curve that will be correlated and respond to the Fed lowering rates. And all else equal, gives you a little bit of cushion into higher rates if that were needed. So again, we have a 4.5, 4.75, 5-year note that you've only had 4 months in the past 13 years. And that's something that, investors are finding attractive. And so from that standpoint, we kind of like the belly of the curve. We like we like holding hands with the Fed. And at some point they will begin to lower rates. Maybe it's a little further out than markets had thought. And that gives us comfort that at some point that will happen either later this year or sometime in 2025.
Now, Michael, Powell did dismiss the potential here to raise rates, but I'm curious, from your perspective, what is the bar for the Fed to hike?
I think the bar is pretty high right now. The Fed has this belief that inflation has moved materially lower from its peak. So we had inflation at 9% at the highs. It's down to a core PCE of 2.8. Whether or not it ticks back up to 3 something. This is not the inflation that it was a year and a half ago, and so the Fed views themselves as restrictive. Whether or not they are restrictive, I think we can certainly have that conversation. They view themselves as restrictive, and so they will need to be convinced with a fair amount of data that the economy is strong and momentum is strong, and inflation is not only holding but reversing and moving a fair amount higher. And so,
Michael,
yes,
is the Fed restrictive from your perspective?
I think that is an open question. I think based on their models of where they think the real neutral rate is, they are restrictive. I think based on the levels that we've seen in growth, based on the acceleration in inflation, I think you really have to squint to see the Fed and rates being restrictive. I think if you saw the first quarter that took place in credit markets, the borrowing that took place in credit markets, whether it's investment grade, high yield, and bank loans, that was record issuance. So folks borrowing and putting that cash to work, to me, doesn't tell me that rates are necessarily restricting activity. So I think it's an open debate. I think on the flip side, you can argue for lags. You can argue most recently we've seen a slight slowing, and maybe that'll continue. Right. And so I think it's an open debate. And I think, we'll need more time and more data, but the Fed's going to need a lot more data to be convinced that they need to potentially move rates higher again.
Well, I wonder if the lag time that we need is going to be 30 years, because we know that, and this is from Torsten's Lock, 95% of mortgages are in 30-year fixed rates. So is the lag part of long and variable lags going to take 3 decades because we're seeing so many people not impacted by rate hikes?
Yeah, so I definitely think the locked-in mortgages have certainly a lot to do with the strength of the U.S. consumer. The last time we had 5.25 mortgage rates, 30% of mortgages were floating. Today, 5% are floating. The consumer debt to GDP is the lowest it's been in 23 years. Consumers in great shape. It won't take 30 years. The average human stays in their home for about 7 years, but it could take more time, and that just means the consumer is more resilient. Not only are the locked-in rates, the consumer has more equity in their home than they've ever had in history. They have $32 trillion of home equity in their house, and that's also making them feel more confident in spending, maybe saving a little bit less because they've saved so much in their home.
So given that, if the Fed is at their 2% inflation target, we're looking at a crystal ball of the future here, what is the unemployment rate going to have to be at?
Yeah, I mean, we think the unemployment rate needs to move a little bit higher in order to achieve that 2% inflation objective. If you just look around at other developed markets.
So 6%, Michael, 7%?
No. I think 6 or 7% could lead to a 1.5–2% inflation, but that would also be a very different type of environment. We think 4.5 to 5 on the unemployment rate. So another 6/10 to a percentage point move in the unemployment rate would get us probably all the way back down to the Fed's objective. But we don't think the Fed's going to necessarily target their objective. 2 point something on the inflation rate with some confidence that we're moving in the right direction is probably enough for them to begin cutting rates. Again, we can argue if that's a mistake or not, but that seems to be the Fed's current rhetoric and way of thinking.
Data dependent, as always. Michael, thank you so much for joining us. We really appreciate your insights. That was Michael Cudzil, PIMCO's Senior Bond Portfolio Manager there.